Hey, I'm Ben from Modern Graham, and today we're going to do a Modern Graham valuation of Navient Corp. So, Navient Corp is the name of the company, and the ticker is NAVI. The current price is $18.69, and the sector is financial services, and the industry is credit services. These things here are the most important things from the balance sheet that I consider. We have total current assets, total current liabilities, long-term debt, total assets, intangible assets, total liabilities, and outstanding shares. And all of these will come into play in the valuation to come. Over here, we have a chart showing in blue the earnings per share and in red the dividends per share. And you can see that we have had fluctuation in the business cycle. And to combat that in our analysis, we do something called create the earnings per share Modern Graham, which is a normalized earnings of the like a weighted average of the last 5 years to create a normalized earnings. And so we take the last 5 years, we put the most weight on the current year and the least weight on 5 years ago, and that gives us our earnings per share Modern Graham. And that can help smooth things out so that we can see more long-term trends. With dividends, you can see that the company has pretty much just held its dividend at 64. I don't know why this is showing a 0 for stock price. I don't know why it came out that way, but it did. So let's move on here. Stage 1 of the analysis is to determine if the company is suitable for the defensive investor or the enterprising investor. And remember, the defensive investor is one who is not willing to do a lot of research, and so they have a stringent set of requirements for companies that they look at before they consider investing. And let's take a look at those. First up, we have market cap has to be greater than $2 billion. It passes that. Current ratio has to be greater than 2. It fails that. The current ratio here is 0.26. The earnings stability, there has to be 10 years of positive earnings per share, and it passes that with all 10 as positive. And it has to pay a dividend for 10 years. It is one short of that figure, so it fails that test. It needs to have earnings growth of at least 33% in the last 10 years, using 3-year averages at the beginning of it and at the end of the period. Here, the growth is only 29%, so it fails that requirement. The PEMG, the price to earnings ratio, has to be less than 20. Here, it is only 5.32, so it passes that requirement. And the price to book ratio has to be below 2.5. Here it is 0.82, so it passes that. But we only get 4 points, so it is not suitable for the defensive investor. Let's take a look at the enterprising investor. So the enterprising investor is willing to do further research, so their requirements are not quite as stringent as the defensive investor. So looking at this one, we get the current ratio has to be over 1.5. It fails that. The current ratio is only 0.26. The debt to net current assets ratio has to be below 1.1. It's negative here. There's more debt than the net current assets, so it fails that. The earnings stability has to be positive for at least 5 years, so it can't have any negative earnings in the last 5 years. It passes that requirement, and it has to pay a dividend. It passes that as well. And the earnings per share have to be greater than they were 5 years ago. It passes the earnings growth requirement, but that was only 3 out of the 5, so it is not technically suitable for the enterprising investor. That makes it a speculative investment, but there might be a reason to invest in it still, so stick around. Now, if you're enjoying this, be sure to take a moment to like the video, subscribe to the channel, and down in the description and the comments below, there's a link to a free valuation calculator. Go and get that from there. Now, stage 2 is a determination of the intrinsic value. And remember, the value is separate from the price. The value is what the company is worth. The price is what the market is currently willing to pay for it. And remember that you are neither right nor wrong because the market agrees with you. You are right or wrong based on your data. And so let's take a look here. To calculate the intrinsic value, we take the formula that Benjamin Graham gave us in his great book, The Intelligent Investor, and that is value equals earnings per share times 8.5 plus 2 times the growth rate. Now, I've modernized that by using that normalized earnings. And so we have two variables to calculate, the earnings and the growth. Let's get to it. Taking the last 5 years of earnings, we can get our normalized earnings figure of 3.51. And estimating the growth, we take that figure and the one from 5 years ago. We calculate a total growth of 83.45%. Divide that by 5, we get an average growth of 16.7%. And then we have a margin of safety here. Growth is such a key variable in this formula that you don't want to overestimate, or it will cause major changes to your value. And so we cap that at 0.75 of the result from the average growth, and we get to 12.52% as the growth estimate. Plugging that into the formula, we get a value of 117.71. And using this very handy chart here, you can see that is much more than the current price of $18.69. And over here, we can see that the current price is $18.69, which is only 15.88% of the intrinsic value. So this one is undervalued by that as well. You can also look at it this way. You have a value based on 3% growth. Then if the company grows at 3% in the long term, it would be worth $50.90. If it maintains the current level of earnings in perpetuity, then it should be worth $29.84. And if you put price in for value and then solve for growth, you find that the market is implying that the earnings are going to shrink in perpetuity by 1.59% each year. And that is what the implied growth rate is. If you believe the company will grow more than that, or it will shrink less, if you think it will grow more than that, then you would find it to be undervalued. And if you think it would shrink more than that, then it would be overvalued. Coming down here to the Modern Graham grade, we can see that it gets 0 points for not being suitable for the defensive or enterprising investor. It gets 1 point for being a good price to the value. It gets 1 point for trading below its Graham number, 0 points for the long-term dividend growth, half a point for being a dividend yield above 2%, half a point for trading below its industry average PEMG ratio, and 0 for trading below its NCAV, which we'll talk more about that in a minute, giving us a total score of 3, which comes to a B- grade. Stage 3 is further research. So if you've gotten to this point, you've decided that let's say this company is speculative. So maybe you want to do a little bit of speculation in your portfolio, and you've looked at your own analysis, and you've decided that this one is undervalued. Then the next step is to do further research to decide if this is suitable for your individual portfolio. You are the only one who can decide that. You need to look at your goals and your diversification and stuff like that to decide if it is suitable for you. And these are a few things that can help you with that. First of all, the net current asset value. That should be a floor to your value. That doesn't apply here. It's very much negative, so that doesn't really help you in your analysis. But the Graham number could. The Graham number is something that is derived from those defensive investor requirements in order to put a number to them so that you can compare that to the price. And here, the Graham number is 39.77, which is considerably more than the price. So it is trading way below its Graham number. And again, the PEMG is only 5.32. The current ratio is 0.26. The PB ratio is 0.82. The dividend yield is currently 3.41, and it shows 1 year of consecutive dividend growth, but that I'm not sure that's true because the dividend, according to this data, has been static. Moving on to stage 4. So if you've gotten to this point and you've decided that it is suitable for your portfolio, the next step is to look at the chart and do a little bit of technical analysis in order to find the right entry point. That's the only reason you want to do technical analysis. Don't create or don't come to a value conclusion based on technical analysis, but you can look at it to find where the market might be moving to try to get your timing right. And looking at this, things that are interesting, we're at the daily view on the chart, and it has been bouncing right around the moving average here. This is an exponential moving average, and that's the short term in what I'm looking at. And we've been staying above. It did go below that briefly yesterday as of recording this, and today it's back above that. So that's one thing to look at. It appears to be trending upward because the short-term moving average is above the medium term, and the medium term is above the long term. So we appear to be in a bullish environment, which is confirmed by the relative strength index down here. This shows momentum. And you can see going way back, all the way back to June. June was the last time that it was oversold, when that dipped, when that relative strength index dropped below 30. And it has bounced above that. Above here in July of 22, it went into the overbought, which would indicate that maybe it was entering into a bullish pattern then, and then it came back down, and it did not fall below 30 in September. So that kind of confirmed that it was getting ready to enter a bullish period, and that has been shown. The moving average for the relative strength index has been above, the short term has been above the long term for the most part for a while now, indicating that it is in a bullish pattern. However, we are getting pretty high, and you can see that that strength index, the momentum, got into the overbought range in January, and so now the momentum has slowed as the price consolidates. And so it'd be interesting to see what happens coming up. It might come back down a little bit, and that momentum may come down and that give another buying opportunity. But those are things to watch for, and be sure to click on the video on the screen now. It will be another analysis that you will find useful. Thanks for watching, and I will catch you next time. Take care.